Hey guys, Fred Pacelli here. It's currently January 26, 2026, first day of filing for the 2025 tax filing season. Quickly, what I want to talk about is some year-end or really post-2025 tax planning or really moves that you can still make to help reduce your tax liability. So most of these are going to pretty much relate to some late funding of retirement accounts or some sort of health accounts. And then also it's going to be just being aware of what your actual business deductions are and to take advantage of all of them. So the first thing I want to talk about, and we're going to be focusing mostly on pre-tax retirement accounts because those are what's going to reduce your current year tax liability. So the first thing is to take advantage of traditional IRA contributions if you have not yet. For the 2025 tax year, the maximum contribution is going to be $7,000, and that is pre-tax. So that means you will be getting a tax deduction of $7,000. That's not a tax credit. A tax deduction is something that's going to reduce your taxable income by $7,000. So you have until April 15th to do that if you are doing a traditional IRA. Now, for the business owners out there, you have a little more advantageous strategy, which is going to be taking advantage of a solo 401k or a SEP IRA. So both of those, the maximum contribution for the year is going to be roughly around $70,000. It's a little bit more, but for simple terms right now, we'll use the amount 70,000. So for the SEP IRA, you are essentially going to be able to take that up until 4/15 or April 15th, or until extension date of October 15th, depending if you issue an extension. So that is a $70,000 business deduction that you can take, and that will likely flow through to your individual 1040. Now, the key part of that is going to be based off of your profit or the W-2 income you paid yourself if you're an S-Corp. So you do have to have a bit of profit to be able to take advantage of the full amount of deduction. It's normally a 25% of the profit or W-2 income. Now, the solo 401k is a little different. The maximum is about $70,000, but there's two sides of it. There's an employee portion and employer portion. So for the employee portion, which that would be you yourself, you'd be an employee of your own business, that timeline has passed to contribute to. The $23,500 for the 2025 tax year, the cutoff for that was December 31st, 2025. So for the solo 401k, you have about $46,500 you can still contribute to until April 15th or October 15th, depending if you go through with an extension. Now, those are going to be the main ones for normal individual 1040 taxpayers or business owners. Another option that is becoming very popular as well is a health savings account. Those are a little unique, but you also have some time to contribute to those until April 15th. Those are actually unique as in they're going to be pre-tax and post-tax, especially if they're just for medical expenses when you're going to actually spend them. And the last thing I want to touch on is if you are a business owner, be aware of what the deductions are that you could have. Some key ones are the home office deduction, bonus depreciation for 2025, if you purchased any vehicles in your business, if you've been keeping track of mileage, anything like that that you can think of. Make sure you bring it up in conversation with your CPA or tax preparer when you're having this tax conversation in the next few months. You know, they're not going to know everything you've done in your business, especially if they're not having quarterly, monthly meetings with you, or you're not set up with QuickBooks with them. If you only meet them once a year, make sure you explain everything, all the business deductions, anything that was related to your business that you might have purchased, just to ensure you're not missing out on any deductions that are going to reduce your taxable income. So just to recap real quickly, The main things are going to be traditional IRAs, SEP or solo IRAs / 401ks, health saving accounts, and then taking advantage of all the business deductions. Last little bonus thing is if you have high mortgage interest rates or high property real estate taxes, make sure to provide that to your tax preparer, because there is a chance you might be able to itemize instead of taking the standard deduction. So for example, if you have a 7% interest rate on your house, you also are paying, let's say, 5, 6, 7, 8,000 in real estate taxes, and then maybe you even did some charitable contributions, there's a high likelihood you might be able to take advantage of Schedule A, which is itemizing. So, maybe an extra couple thousand in deductions there could make a difference in your tax liability at the end.